And I think the U.S. market now is overvalued and overhyped, and it's in a bubble. So when that bubble pops, you can watch gold take off again, accelerate. If you look at what's happening to gold, the last month it's up, the last 3 months it's up, the last 6 months it's up, year to date it's up, last year, year over year it's up. It's in a bull run, and it's going to stay in one that could be motivated if the U.S. equity markets pull back, which I think they will.
Over the past year, gold prices have repeatedly reached new record highs, even surpassing $2,700 an ounce at one point. As inflationary pressures and global uncertainties persist, investor interest in gold bars, coins, exchange-traded funds, and individual retirement accounts has surged. This growing demand for the precious metal has contributed to rapid price increases, with some experts speculating that gold could soon hit $3,000 an ounce. Although inflation has shown signs of cooling, gold prices have only moderated slightly, avoiding significant declines. This has left many investors and analysts questioning whether the upward trend will resume, particularly as gold continues to be viewed as a hedge against economic instability. Economist SteveHanke has a bullish outlook on gold, citing its consistent performance across various timeframes. He links gold's momentum to underlying vulnerabilities in the U.S. equity market, which he believes is in a speculative bubble fueled by overvaluation and excessive investor enthusiasm. Analysts said that the final ingredient for a full-blown bubble, loose monetary policy, is currently absent, with the Federal Reserve maintaining restrictive interest rates despite a recent 25 basis point cut. However, UBS projects a 35% chance of one forming by 2025 if the Fed eases rates significantly, potentially spurring a risk-on mentality in equities. When the U.S. equity bubble bursts, Hanke predicts gold prices could accelerate sharply. He draws attention to the contrarian view that when consensus overwhelmingly favors U.S. markets as the dominant investment option, it often signals an impending correction. Such a shift would likely steer investors towards safe haven assets like gold, reinforcing its role as a cornerstone of wealth preservation. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think I remain a bull, and whether you define it early, middle, late, or it's the bull run will continue. What could really elevate things or change things is, I think, what really is in effect a bubble in the U.S. equity market. From an international point of view, 70% of the world's market cap is in the U.S. markets. The rest of the world doesn't count. This is amazing. And in 1980, the market cap in the U.S. was about 30% of the world's markets, which was kind of in line with the size of the U.S. economy relative to the rest of the world. U.S. economy is, it's about 27, 28, 29, 30%, depending on how you measure it. But it's more or less, let's say, around 30%. And in 1980, the market cap was about 30%. Well, now it's skyrocketed. Everybody and their brother want into the U.S. market. And I think the U.S. market now is overvalued and overhyped, and it's in a bubble. So when that bubble pops, you can watch gold take off again, accelerate. If you look at what's happening to gold, the last month it's up, the last 3 months it's up, the last 6 months it's up, year to date it's up, last year, year over year it's up. It's in a bull run, and it's going to stay in one that could be motivated if the U.S. equity markets pull back, which I think they will.
Well, let me ask you this then.
And by the way, one reason that I say that I use the word bubble is that when you get every dog and cat saying the same thing, that the U.S. is the only place to be, the U.S. is an overachiever, the U.S. this, the U.S. that, and we all want to rush into the U.S. That's when my contrarian juices get flowing, Jesse. So something is wrong. If everyone is saying exactly the same thing, it's about ready to pop. I think you have to. China, of course, is the elephant in the room when it comes to commodities. So you got to watch China. Now, China has just made the Politburo last week made an important statement. They said that they wanted to have loosen up on the money, and they're right, because Hanke's golden growth rate for the rate of growth in broad money in China is a little over 11% per year. And that would be a rate consistent with hitting their inflation target of 3% per year. How fast is it actually growing? It's growing about 6%, way, way below. They're suffering from anemic growth in the money supply. So what the Politburo said is the right thing. They want to increase the money supply. Whether they're going to be able to pull that off or not, I don't know. But if they do, then that's very positive sign for commodities.
Recent developments suggest an escalation in U.S.-China geopolitical tensions, with President-elect Donald Trump signaling a more aggressive stance on strategic maritime choke points, including the Panama Canal and the Strait of Malacca. Proposals such as a 100% tariff on Chinese goods and reclaiming control over the Panama Canal reflect a harder-line U.S. policy to curb China's global influence. Simultaneously, geopolitical challenges in the Middle East continue to unfold. The Wall Street Journal highlights the deepening rift between U.S. allies over the conflict in Gaza, with tensions spilling into Syria and other regions. Israel's strategic objectives remain clear, securing its national interests through military and technological superiority, countering Iran and its proxies, and ensuring long-term security. These developments, coupled with conflicts in Ukraine, Sudan, and the Middle East, contribute to widespread geopolitical instability. Economist SteveHanke points to these factors and the escalating U.S.-China rivalry as drivers of economic uncertainty and geopolitical turmoil. Hanke also underscores the broader implications of these crises for Europe, where fiscal pressures and political instability are mounting. With Russia asserting dominance in Ukraine, the likelihood of prolonged and unstable peace negotiations looms, exacerbating the region's challenges. Let's get back to the interview.
We've never had this many unstable instabilities occurring at the same time. You mentioned the war in Europe, and you mentioned also, let's say, the broader Middle East war and military activity and aggressions of the Israelis, and completely unknown of what's going to happen in Syria. I mean, it's going to. I think it could end up in a completely chaotic situation. And don't forget, the big thing is the commercial war, if not geopolitical war, that the U.S. is in with China. You have the two biggest economies in the world are at loggerheads. So everything is. And just another little thing. How about Sudan? We got a big war going on in Sudan. We have a huge number of casualties. We're going to have a big famine in Sudan. A lot of displaced people, a lot of people killed, and so forth. So everything is bad from that point of view. I would say I can't think of, well, now that I'm thinking about it, maybe the island of stability or quasi-stability might be South America, but the U.S., remember, is on the attack against Venezuela, so we don't exactly know what's that to the extent that there it's kind of an unstable equilibrium with the U.S. versus Venezuela. So let's go back to Ukraine, because Trump has indicated that he'd like to have that thing wound up as fast as possible. But the real situation is that the Russians have already won that war. Most people don't realize the Russians have won. And when the shooting stops and they come down to negotiations, what the Russian position is very clear. Number one, Crimea is part of Russia and they're going to keep it. And the occupied territories in Eastern and the Donbass, they're going to keep all of those. And they're going to demand that Ukraine not be a member of NATO, either de jure or de facto. So that's the negotiating position that the winners of the war will be taking. And my conclusion is that's going to be tough medicine for the West to swallow. And the negotiations on this are going to drag on for a long time. So if there is a peace and they stop shooting, it's going to be, shall we say, a Cold War, an unstable situation for quite some time. Trump is not going to wind this thing up in a hurry. And what has been the collateral damage associated with that? Well, Europe's economies have been destroyed by by the war against Russia. And the other thing is that the fiscal situations in the European countries, many of them are in fiscal hot water. Just look at Germany. They just had a no confidence vote. They've thrown out the government. They're going to have a new election in February. You've had the same thing a couple of weeks ago in France. And those are both because spending money at the margin for increasing defense, if you have no room or margin of safety in your budget, you're in trouble. Germany is tanked. Germany is in terrible shape, and France is in absolutely terrible shape. Moody's has downgraded them just recently.
The interplay between geopolitical tensions, economic vulnerabilities, and market dynamics continues to shape the global financial landscape. Gold's resilience amidst these uncertainties highlights its enduring role as a safeguard for wealth preservation. With rising demand and looming risks in equity markets, gold's trajectory remains closely tied to investor sentiment and broader economic developments. As the world grapples with heightened instability, the precious metal's appeal as a hedge against potential downturns solidifies its place in diversified portfolios. How do you see the evolving geopolitical and economic landscape impacting gold's role in investment strategies? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.